And good morning to all of you, depending on which geography you're logged in from. Welcome to the Q4 and full year FY18 results. The results and presentations have been mailed to you earlier in the day, and you can also view this on our website at www.mastek.com. To take us through the results today and to answer your questions, we have with us the top management of Mastek, represented by Mr. John Owen, the Group CEO, and Mr. Abhishek Singh, the Group CFO. John will start with a brief overview of the quarter gone past and the year, which will then be followed by Abhishek, who will go into the detailed financials of the company. I'd like to remind you that everything said on this call that reflects any outlook for the future or which could be construed as a forward-looking statement must be viewed in conjunction with the risks and uncertainties that we face. These risks and uncertainties are included but not limited to what we mentioned in the prospectus filed with SEBI and the subsequent annual report that you can find on our website. With that said, I would like to hand over the call to John. Over to you, John.
Thank you, Devakar, and let me extend my welcome to everybody and thank you. I think as we've said in our briefing, we're very proud and pleased with our results. I think they show our 8th consecutive quarter of revenue and earnings growth, and that I think that strategically we've moved the organization forward under our Vision 2020 initiative, which in simple terms was year one was to fix some of the fundamentals and build predictable and consistent performance. And we're exiting that and we're moving into our win theme for the next 12 months and then our major growth phase in year 3. So I think we have clarity of purpose, we've got clarity of direction, and I think we've built good momentum and we're now starting to yield the benefit of that with good performance. So our financial performance, I'll let Abhishek go through, but I think we are delivering our strategy. I think we're building capacity in the organization, and that's measured by, we've now got over 2,000 employees, and we've increased our customer base with new logos, and we've had 170 customers in the last 12 months. So you can see that we've got clarity, we're executing the strategy, and I'll hand over to Abhishek to give you the details on the performance, and then we'll come and hopefully answer some of the questions and fill in the colour for you. But thank you.
Thank you, John. Hello, everyone on the call. We'll go through the financial performance of Mastek for the current quarter. Before the call, we had a text circulated, so we'll refer to that for this call. Moving on to slide 4 of that deck, it's the Q4 financials quarter-on-quarter comparison. In terms of revenue, our total income stood at 230.8 crore, up 7.2% quarter-on-quarter. Operating income at 223.7 crore, up 6.8%. In constant currency terms, our revenue grew by 5%. On profit metrics, our EBITDA stood at 35 crore for the quarter, up 10.9% quarter-on-quarter. EBITDA margins expanded by 50 basis points quarter-on-quarter. Net profit stood at 19.4 crore, up 1 crore quarter-on-quarter. And this is after the impact of DTA charges that we took in our tax line for the quarter. Net profit margin stood at 8.4% vis-a-vis 8.6% for the last quarter. Cash and cash equivalent at the fair value of mutual funds and the cash stood at 205.7 crore for the quarter vis-a-vis 167 crore for the last quarter. Our 12-month order backlog stood at 524.8 crore, up 20% in INR terms and 12.3% in constant currency terms. Moving on to next slide, it has the year-on-year performance comparison. Revenue at 230.8 crore, up 25.7% year-on-year. Operating income at 223.7 crore, up 25% year-on-year. In constant currency terms, our revenue grew by 21.9%. In terms of profit parameters, EBITDA stood at 35 crore, up 64.8% year-on-year. EBITDA margins stand at 15.1% vis-a-vis 11.6% last year, this quarter. That's a margin expansion of 3.5%. Net profit stood at 19.4 crore versus 10.7 crore last year, which is up 81.6%. And net profit margin is at 8.4% versus 5.8% last year. Cash and cash equivalent at the end of current quarter stands at 205.7 crore versus 153 crore last year. and the order backlog 12-month stands at 524.8 crore versus 333.3 crore last year, which represents a 57.5% growth year-on-year. Moving on to slide 6, this gives you a full year comparison of fiscal 18 vis-a-vis fiscal 17. Our revenues grew by 46.3% at 838.2 crore. Our operating income grew by 45.9% to 817.2 crore. In constant currency, it represents a 52% growth year-on-year. In terms of profit metrics, EBITDA stood at 120.7 crore, up 97.3% year-on-year. EBITDA margins also expanded by 370 basis points. Net profit at 70 crore versus 32.4 crore last year, a growth of 115.9%. Net profit margin stood at 8.3% versus 5.7% last year, up 260 basis points. Next, slide number 7 is just a tabular representation of all the financial statistics that we talked about minutes back. So I will move ahead to slide number 9, which talks about the operating metrics. We added 9 new logos in the quarter gone by, and our total active client over last 12 months stands at 170 now. Our top 5 client contributed 40.3% of the revenue, and top 10 contributed 57.2% of our total revenue. Our total employee base expanded to 2,058 count, of which offshore has 1,327 and on-site has 731 count. This compares to the 1,902 that we had at the end of last quarter, of which 1,252 were offshore and 650 were on-site. Our DSO stands at 67 days, down from 73 days for the last quarter. Forex hedges for the next 12 months stands at 12.3 million pounds at an average rate of 91.7. And as a result of this performance, board has recommended a final dividend of 80%, which takes our total dividend for the fiscal year to 120%. Moving on to next slide number 10, it has got the revenue analytics. Revenue by market and region, UK continues to be the bedrock at 72%, and US was at 26.8%, and others are at 1.1%. Revenue by industry segment, retail continues to be the largest vertical for us at 35.6% of the total revenue, government at 31.9%, financial services has maintained its northward trajectory and is at 22.9%, and others are at 9.6%. In terms of revenue by contract type, T&M continues to be the major chunk of our revenue at 75.5%. However, fixed price has grown this quarter, and it is at 24.5% of the total revenue. Moving on to the next slide, which is the revenue by service line, as we had signposted a few quarters back that we look at our business in terms of service line and not just the verticals or the geography. So AppDev continues to be the major revenue contributor at 47.6%. Digital commerce is at 23.8%. BI and analytics has made a good growth quarter on quarter, and it is now in double digit at 10.6%. Application support and maintenance is at 10.5%, agile consulting at 4.3%, and testing at 3.3%. So these are the dynamics of our revenue and financial performance. I will hand it back to the floor for questions, if any. Thank you.
Thank you very much. We will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Mohit Jain from Anand Rathi. Please go ahead. Excuse me, Mr. Jain, I'm sorry to interrupt, but your voice is not very audible.
Is it better now?
Yes, you may please proceed now.
Are you looking at some kind of price pressures in, particularly in the fourth quarter? Because I was just trying to calculate your volumes and revenue per employee. It seems slightly on the lower side if you adjust for the cross-currency benefit. So if you could help me understand that, that would be great. And your outlook on pricing for FY19.
So Mohit, it is not driven by any pricing pressure. It is essentially the cost of growth, the cost of mobilization, the headcount that we have added, and the time that they went live. It is the carrying cost and the time they spent contributing to the revenue in the quarter vis-a-vis the idle time. This is not driven by any pricing pressure.
Sorry to interrupt, sir. We again can't hear you that well. May I request you to please speak from the handset?
But let me try again. Looking at the lever for improving margins.
Well, ladies and gentlemen, we've lost the line for the current speaker. We take the next question from the line of Dipanjan Basudankar from Seawood Mackerage. Please go ahead.
Thank you for the opportunity, sir. Just to ask you, we had a fantastic quarter in terms of profitability, both for the quarter as well as for the entire year. So, will this profitability will be sustained next 1 or 2 years? And, how much growth are we looking from here on for the next 1 or 2 years? And how will that growth be made possible? 1 or 2 drivers that you can specifically mention.
Thank you for your compliment. As far as performance is concerned, we have singular endeavor of maintaining a consistent and predictable financial performance, and that includes quarter-on-quarter growth and improving the quality of earning. So the levers that you can look at is essentially the businesses that we win and report as 12-month order backlog. That has given a good growth across the 2 quarters. Our pipeline is also very robust, and the kind of investments that we have made for market coverage both in UK and US is coming to fruition, and that gives us the confidence of maintaining the trajectory.
Okay. So, so this level of growth, so next 1 or 2 years, what is the percentage growth that we can look at approximately?
We endeavor to maintain the trajectory. That said, none of us can here either predict or guide you to the level of growth that we are looking at.
Fine. Okay, sir. Thank you so much.
Thank you.
Thank you very much. We take the next question from the line of Nirmal Wari from Samiksha Capital. Please go ahead.
Hello.
Yes.
Yes. Thank you, sir, for taking my question. My first question is on the order book that we have reported, 524 crores. So this is for the entire order book. What would it be the comparable number for 12 months executable?
This is the 12-month order book, Nirmal.
Okay. So I think in Q3 we started reporting the total order book. So this is for 12 months, right? So it is comparable with the 333 crores of last year.
Yes.
Okay. And so the second question is it possible to give an on-site and offshore split of revenues? We give the total number of employees on-site and offshore, but we don't have the revenue split.
The revenue on-site offshore is roughly 70-30.
70-30. Okay.
Yeah.
Okay, thanks.
Thank you. We take the next question from the line of Ganesh Shetty, individual investor. Please go ahead.
Hi, sir. Congratulations for excellent set of numbers. Sir, this year totally we have added 40 new customers. And if we see by percentage, that is around 24% of our total number of customers over a period of time. So are you seeing any growth from these new customers, like bigger order or new type of digital business Can you please elaborate, just the quality of customers what we have acquired during this quarter?
Okay, thank you. And I think I would say that's probably where Mastek differentiates versus its competition. The quality of our customers, we're dealing with global enterprises and national governments, be it the UK, Morrison's, Brandsmart in the US. So the quality of customer is very good. What we're finding with the enterprise digital transformation market is it's starting small with projects as people prove out the model, and I think that's where Mastek's doing well at inserting as a new supplier against some of the traditional IT services. And in the digital world, the decision is around time to business impact, where in the old IT services world, it was the cost of the inputs, the rate card and the CV. So I think we're differentiating well because we've got a track record in engineering excellence and delivery track record. So I do expect the investment we've made in account management to yield growth because we're delivering on that commitment to our customers. But these customers have, we're looking at our share of wallet, and at the moment there is plenty of upside within our existing accounts if we continue to execute well, and we're seen as the partner for those growth initiatives because digital will displace traditional IT services as the budgets evolve. Hopefully that answers the question.
Yeah, yes, that's fine, sir. Sir, second question is regarding our revenue composition. Actually, we were mostly a UK-based company, and most of our revenues used to come from UK. And this year, I see there is a change in our revenue mix, and we're able to derive substantial growth from US geography also. And it must be due to our acquisition in the US. And also I wish to ask whether our organic growth in the US is in place and our cross-selling opportunities with TISAC is in place. And also the TISAC capabilities are, also getting business over in UK geography. Can you please throw some light on this?
Yeah, and I think we've signposted that our direction of travel is we want to balance out our revenue between the UK and the US. But you're right, we're starting from a very well-established organisation in the UK with mature relationships and a reputation and infrastructure. And the US is a bit more like a sort of a nascent business for us, and we acquired TaseTech. The difference with the TaseTech business is that's linked and aligned very much to Oracle because we're in that Oracle Cloud Commerce. So we do there is probably more seasonality in our American business as that links to the Oracle both fiscal year, so their quarter rollout is different, and obviously the retail exposure. Lots of people want to build there. So in our Q1, Q2 is a good indication of how we're executing on that integration because that lines up with Oracle. Regarding the cross-selling, that is the strategic goal, and we have one account. So we are posting some cross-selling success, and the pipeline's encouraging. But again, that integration is 12 months old. We're optimistic, and we're moving in the right direction. Would we like that to be as mature and as developed as our UK business? Yes, but I think we've got to go through that sort of gestation period with the integration, line it with Oracle. Likewise, we do want to sell back in that capability into the UK market. What I think Tase gives us is, one, balancing out our revenues by geography is number one. Number two, it probably puts us in one of the most innovative markets of cloud commerce, and that's where everyone in the US market is competing against Amazon. So the market's driving innovation very quickly, and the way to succeed is based on improving customer experience. In order to do that, it's about the user experience. So I think we're picking up some technical competencies out of the Tase acquisition in user experience that we're then taking that capability back into our UK customers. So the US market in retail is probably 12 to 18, if not 24 months ahead of the UK market in digital adoption and that maturity curve. And that's the other asset we're getting from that acquisition is we've got an insight into how the customer experience is changing and how we can take that into our existing customers.
That's fine, sir, and congratulations once again for excellent set of numbers and taking Mastek forward in the growth path. Thank you very much.
Much appreciated.
Thank you. We take the next question from the line of HR Kala from Finvest Advisors. Please go ahead.
Yeah, congratulations for good set of numbers. Hello.
Thank you. Yeah, please.
Yeah. So as far as the U.S. Geography is concerned, do you think that we are getting closer to or are we exceeding what we had originally expected?
Not really. We are just getting started in U.S. geography, especially with all the investments that we have made in our selling capability.
Okay.
In the geography, we made an investment in a very geography head. We made an investment in sales and marketing capability as well as specific marketing initiatives and lead generation. All of that has happened over last 3 to 4 months. The result of which we would expect to see over next 12 to 18 months. So getting started in the geography.
Okay. But over a period of, say, next couple of years, how do you see the U.S. geography contributing to our overall sales?
As I say, we'd like to balance out the revenue from the two key geographies of the UK and the US, and obviously the US is coming from a lower base.
Yeah.
So that's the objective. I think there's a difference in our revenue from the US because it lines very much around the Oracle product positioning, how they roll out their technology, and probably the sales cycles are a little bit longer than they are in the UK. So those are the two things that we're trying to balance. So you can't compare the UK and the US at the moment as comparable markets. But over time, as we do cross-selling and we keep those customers for life, hopefully you'll start to see that revenue become a little more predictable between both markets.
Okay. So do you expect UK and US to be almost contributing equally over a period of time?
Correct. But that's a strategic direction of travel, not in the next 12 months. Because, again, the base. And I think the other bit is to recognise the UK business is continuing to grow. So it's not at the our balancing is not at the expense of the UK growth.
Okay. And how will that kind of transformation will result in the EBITDA margin going ahead?
So we expect that as the sales and marketing investments yield result, the upward bias would be maintained, and it should result in the quality of earnings improving over a period of time.
Okay, that would be great. As a last question from my side, you are working on several projects for the UK government and different departments. And also we had charted a course that, beyond the certain departments where we are currently working, you wanted to migrate to some other department. So has any concrete progress been made on this line?
Yes, so I think a lot of people will talk about Brexit, and certainly up in probably the last 12 months, Brexit has dominated a lot of UK central government thinking.
Okay.
Capacity. That being said, we've actively invested in account management, and that's giving us a better pipeline of cross-selling both capabilities into our existing accounts and also opening up new departments. I think the other part of Brexit is, and I think we signposted this last time, the UK government will need to invest in 34 new departments, and that will create opportunities for new bids, because those capabilities are currently provided by European agencies, and that isn't going to obviously no longer be available at the end of next year.
Okay. And so the UK model, can we replicate in some other geography, other European countries?
The philosophy is yes. However, at the moment, we're ruthlessly focused on executing in the UK and the US and just being disciplined in those two markets. Going into Europe sounds nice, but I think their appetite to work with Indian technology companies is different. You've got the different complexity of the euro, you've got culture, you've got language, and we don't have footprint. Both the UK and the US at the moment present very good upside without us going and expanding in footprint.
Okay. Thank you very much, sir, and wish you all the best.
Thank you.
Thank you.
Thank you. We take the next question from the line of Nisarg Vakaria from Lucky Investment. Please go ahead.
Hello to everyone and congratulations on a very solid set of numbers. I had a question on, the first question was regarding your other expenses which have shot up quarter on quarter and Y on Y. Can you throw some light on that, please?
Sure. So that includes the temp staff augmentation that we do for certain work, and you can look at it as subcontractor-related expenses in UK geography.
So these expenses are proportionate to the top line that you do, right?
That's correct. And it also has a bit of an exchange impact.
Okay. My second question was the slight softness in the revenue from North America operations. Can you please throw some light on that?
Sure. So it has two components. One is our digital commerce business, and the other one is a small organic green shoot that we had. In that initiative, we had a large part of its project work coming to conclusion that caused the softness. That said, other statement of works and the initiatives are in progress with the same customer, and that's what gave you the softness between the 2 quarters.
But the operating leverage on that business is so high because quarter on quarter, our EBIT margin has almost halved in the North America operation.
That's true. It is also aggravated by the fact that some of our heavy-hitting sales and marketing investments came in at early part of this quarter, that is in around Jan.
Okay, and those expenses are in which line? They are in the other expenses?
Correct. They are the sales and marketing expenses.
Okay. Thanks a lot, and all the best.
Thank you.
Thank you. We take the next question from the line of Ashutosh Karut from Reliance Well. Please go ahead.
Hello.
Hello, yes.
Yeah, hi. Congratulations on a very good set of numbers. So just when you mentioned about confidence in your business to continue the kind of 25+% of growth in the top line front, so would that also mean that we have a few operational leverage yet to fructify in our EBITDA margin? So would the margins be improving as we go along?
Yeah, so that's an interesting question. If you actually look at it, look at the growth trajectory that we have had, you are continuously in the state of ramp on some of the other programs. And to complement that, we have also invested in sales and marketing. And that sales and marketing investment has come in without diluting the EBITDA. As a matter of fact, we maintained the northward bias on that. So the business is giving you the efficiency, which is what we are using to invest further and increase our reach. And that's the sales and marketing investment or the capability investment that we have made in UK as a geography. So yes, the answer to your question is yes, we have had efficiencies, and that's what we have used to invest in the business further.
So incrementally, we would be seeing the margins improving. Are there more levers yet to be seen taking effect in the financial metrics?
The biggest lever is the investment that we have made in sales and marketing. As that helps accelerate the growth, you will see the returns coming in the performance.
Okay. Thanks a lot.
Thank you.
Thank you. Before we take the next question, I would like to remind all the participants, if you have a question, please press star and 1 on your touchtone telephone. We take the next question from the line of Mohit Jain from Anand Rathi. Please go ahead.
Hi, sir. Am I audible now?
Much better, Mohit.
Okay, thank you. So I had 2 questions, both related to margins. So one is this offshore percentage of work, which in our case is comparatively lower in comparison to some of the other IT companies. And second is related to SG&A. So one is that from an FY19 or FY20 perspective, are you looking at increasing offshore proportion of work and look at it as a lever to improve your margins from here?
The offshore portion for us definitely is lower compared to some of the other IT services firm. But Mohit, if you look at what we are trying to do in digital transformation work or in digital initiatives that we had shared in some of the earlier calls, this involves significant onshore delivery. It requires the best of the breed having a conversation. That's your first foot in the client's door, and not a grade mix, not an onshore-offshore mix story. And that's what we have been doing. As you see the revenue mix, see the type of work that we have been doing. So it will be driven by that. That said, we are always open to the requirements of the customers. If they want an ODC, we have done that in last quarter as well. If they are looking at constrained budget, then we suggest the onshore-offshore mix to be tweaked that can help them attain their desired objective. And we are open to every possible opportunity to make it work for our customers and for us as well.
But I think just to build on that, Mohit, I think in the digital world, there has to be a significant contribution of on-site resource. And I think that, one, we know how to build that mixed delivery model probably better than anybody. And secondly, I would expect old IT companies, they're going to struggle with this new dynamic, both in cost structure, because in the digital world, it's not about scale and capacity. It's about dynamism and knowing what the customer impact is. And this idea of you can just take a contract from one market and deliver it in offshore, I think that's, in a stable environment, that's probably relevant. Digital is not stable. It's about understanding the customers and having the right engineering talent. But I think, as Abhishek quite rightly said, as that market matures and as our confidence, people will start to migrate some of that work to offshore. But they're not going to start with a pure offshore delivery because the business impact in digital is just too high.
So from where we are currently in terms of on-site offshore percentage, you only find it like a little movement towards offshore over the next 2-3 years, but nothing significant in terms of your reported numbers.
No, I think we're seeing customers that we've been on this digital journey for probably the last 18, 24 months have more confidence and start to look at the economies of scale of moving to offshore. So we are still growing our offshore, but I think as a new client building that confidence, it's that mixed delivery model that builds the confidence in our delivery track record.
Okay. And second is on SG&A. Like SG&A has gone up, but are you at a level where it will remain steady now as of 4Q average, or should we assume another step change in SG&A in FY19?
Can you repeat that, Mohit?
In terms of hiring of staff and addition of sales capability and senior leadership, are you done with it in the fourth quarter? And should we assume that the cost will now remain steady for FY19, or should we assume another step change in FY19?
Yes, thanks. See, this is very dynamic. It is a function of the opportunity that we see and the coverage that we can afford as well as desire. So at this point of time, yes, we have made significant investment, and we'll look at further investment based on our affordability as well as the success of the investments made.
Okay. And lastly, on the tax rate, like what should be your FY19 tax rate, given that it is going up for last few quarters?
So the quick clarification on that is this is the quarter where we took the DTA impact, the deferred tax impact due to the change in the tax rate in India. And this was a one-time stuff. Other than that, the ETR that we guided to remains consistent.
Which is, can you just quantify it? How much is it for 19?
Right. Yeah, it should be around 24%. 24%
consolidated?
Yes.
24% consolidated. Okay, great. So that will give a big earning figure in the next year, is it?
We don't look at tax as a line of contribution. We work the business and we work all the opportunities.
No, understood, sir. Thank you very much.
Thank you. Thank you.
Thank you. We take the next question from the line of Parag Barandi, individual investor. Please go ahead.
Yeah, hi. Congratulations for the good set of numbers. John, at the start of the conversation, you mentioned about the Vision 2020, Mastek's Vision 2020. Can you elaborate that a bit more in terms of what are we trying to achieve this year and the next year?
Yeah, so we, as a board, we obviously started this digital journey about 2 to 3 years ago when we divested our product business and got in Majesco, and we released shareholder value, and it allowed both companies to operate as standalone entities. We then acquired, as Mastek, which was essentially the residual business, we then acquired Agile capabilities through the acquisition of Indigo Blue, because Agile, open source, and digital, those are the components you need to make an organization successful in this market. Last year, it was all about the change to independent or external management, so that was the appointment of Abhishek and myself over the last 2 years, to build basically the baseline of the organization, get the reporting, get the data sets, get the discipline, get the scale, because this is going to be a fast-growing organization, and we don't want to hit a plateau and sort of miss the opportunity, because digital is growing quickly. So the first year of my sort of tenure, which is now coming to an end of this fiscal year, was all about building the infrastructure, getting the processes, getting the right people, getting the management team, and building confidence with our investors of this is the journey and we are building that predictable and consistent performance. This year, last year we also invested in account management because we have very good relationships with customers, and some customers we've been with for 15 to 20 years. So when you are a Mastek customer, you tend to stay a Mastek customer. So we've invested in account management skills to basically increase our share of wallet, particularly in the digital space. This year is about how do we acquire new customers who have never worked with Mastek before. So there is an investment in that, and that's why we've coined it the win year, because it's how do we break the new business. Because I think traditionally people looked at economies of scale being the differentiator. How much is your resource? What's the rate card? I can aggregate an economy of scale. That doesn't work in the digital because it's about time to business impact, and that's where people look at your delivery track record, your engineering excellence, and the projects that you're doing. So that's where we're focused now. The year after that, we've always said that we will use our cash at the appropriate time to grow our organisation. And I think the difference with Mastek to a lot of other companies is this is an organisation that's got sort of stability and clarity of direction, but it will go back. We're about executing and building confidence both with our customers, our employees, and obviously our investors. So hopefully that gives you a little bit more colour.
Yeah, thank you. One of the things you mentioned for the FY19 is you are targeting that as win year, right? But if I take Mastek revenue for last 10 years, and if I see number of customer added, last 2 years has been fantastic on its own. So you had like 30, 40 client win on its own. So how do you think this financial 19 year will be different than what Mastek had done for last couple of years?
I think we should be very proud of the last couple of years, but quite frankly, my culture is we go back to zero and we start all over again. So I think I will tell you, complacency will have no place in this organisation, and we earn the right to deliver to our customers and serve our customers, and we earn the right for our employees to come and create their opportunities with us. So it's attention to detail and just doing the basics and the fundamentals day in, day out. There's no sort of, now we've achieved it, we can go on to something. We're only as good as our next delivery.
Another thing is, UK revenue has increased from, say, 118 from Q4 17 to 161. And is that momentum, are you seeing the momentum continuing next 2 quarters, 3 years?
I see good fundamentals in the business, i.e. the market, the pipeline, our coverage model, but I don't think it is appropriate to guide on what the growth trajectory would be.
Okay, that's fine. Thank you very much, and all the best.
Thank you, appreciate it.
Thank you. We take the next question from the line of Mr. Sanjay from Ampersand Capital. Please go ahead.
Yes, sir. So, you have already discussed this, but still I just thought if you can just add a little more color on the U.S. geography. You mentioned something which is why your sales decline or not great on quarter-over-quarter basis. Can you just tell us about how it will pan out going forward, and what kind of really growth that you are really looking at in U.S. geography?
Thank you for your question, Sanjay. The U.S. as a geography, our growth engine there is the digital commerce transformation opportunity that retailers provide us with. The asset that we bought in TasteTech was operating specifically with Oracle. It's a gold certified partner, has got good credibility in the market and a marquee set of customers. As Oracle makes its pitch to transition its ATG customers to cloud commerce, that's the stuff that presents us with tremendous opportunity, and which is where we have made the investment, both as the head of the geography, in the sales leadership, the account mining approach, as well as lead generation approach. So without hazarding a guess on a percentage, we can signpost that there is an opportunity. There is a capability, there is opportunity in the market, there is capability in the organization, and we have accorded ourselves the investment to materialize that opportunity.
Can you just give us a sense of time, like when one will see the benefit of that coming in? So not the entire one, but at least some directionally when one will get to see that it is flowing through.
We all would love to have that timeline, Sanjay. But that said, you got the sales and marketing in, you got those nuts and bolts done in this quarter. Now we are hitting the market and hard with all whether it is target operating model, go-to-market strategy, collaterals, and whatnot. Now, the endeavor is on, and we'll keep watching the space.
So if I can just try to extract from you, like this Q4 was the bottom, so to say, can you say that?
I will not give you any guidance.
Sure. Thanks a lot.
Thank you.
Thank you. We take the next question from the line of HR Kala from Finvest Advisors. Mr. Kala, your line is unmuted. Please go ahead with your question. Well, that seemed to be the last question. I now hand the floor back to the management for their closing comments.
Okay, thank you very much for joining us today and asking your questions. As I say, I've always said it's a real privilege to lead Mastek. It's got a great heritage. It's got great values, and I think those are the things that differentiate us in the market. And I'd just like to pay tribute to the loyal employees of Mastek for basically serving our customers so well. Our job as leaders is to create an environment for them to be successful. And I think, hopefully you've seen consistency, you've seen predictability, and we're on a journey. And we've got some pretty good, high aspirations over the next few years. But I'd just like to thank you for your support, your interest, and your best wishes, and we look forward to serving you in further quarters. Thank you.
Thank you very much. Ladies and gentlemen,